Hello, I'm Adrian Finnegan, and this is Counting the Cost on Al Jazeera, your weekly look at the world of business and economics. This week, it's being called a competitiveness crisis. The EU's investment, income and productivity are lagging behind the US and China. So can the bloc's economy catch up? Modi wants India to become a developed country by 2047, but with a reduced parliamentary majority, can the Prime Minister push through his economic reforms? And it's the second largest source of income after hydrocarbons for Saudi Arabia. The religious tourism sector is boosted this year by the increase in the number of Hajj pilgrims. Struggling with slow growth, weak productivity and changing demographics, Europe's share of the global economy is shrinking, and it's lagging behind the US and China. Its leaders are worried that the continent might not be able to catch up and want to make the EU more competitive. To achieve that, the former president of the European Central Bank, Mario Draghi, says the bloc needs radical change. But getting more than 24 nations in the bloc to act jointly and carve out a way forward is challenging, to say the least, as Katia Lopez-Hodayan reports.
Europe's economy is struggling to keep up. The US and China have outpaced the European Union in investment, income, and productivity. The world is changing fast, and staying competitive is a new and growing challenge. Italy's former Prime Minister Mario Draghi is heading a study of Europe's competitiveness. He warns the EU is working on an outdated framework designed before COVID, before the war in Ukraine, and before rivalries between superpowers.
We need a European Union that is fit for today's and tomorrow's world. And so what I'm proposing in the report that the President of the Commission asked me to prepare is radical change. But that is what is needed.
That radical change, he says, requires additional investments of about $550 billion in green and digital technologies every year. Ambitious plans to boost renewable energy and domestic supply chains are falling behind. Productivity growth is slower than other major economies, while energy prices are much higher. But there are signs of improvement. The European Central Bank issued its first interest rate cut in 5 years, lowering 0.25 percentage point. Progress has been made in tackling inflation, but the fight is far from over.
Despite the progress over recent quarters, domestic price pressures remain strong as wage growth is elevated and inflation is likely to stay above target well into next year.
In the recent EU elections, far-right parties made gains, adding uncertainty to the bloc's political and economic direction. More than 24 countries make up the EU. They may share the euro, but they often differ in priorities, strengths, and long-term vision.
We have a lot of problems. We're dealing with rising prices and also migration. These issues haven't been addressed properly by the same political system that's been governing Europe for decades.
How these countries move forward now as a bloc will likely determine their economic ranking and competitiveness for generations. Katia Lopez-Hodayan, Al Jazeera, for Counting the Cost.
Well, let's take a look at how the European and American economies compare, for example. Bloomberg Economics says the gap between the two in terms of GDP amounted to 18%. That's more than $3 trillion between 2000 and 2023. It predicts that shortfall will reach almost 40% by 2050. Private investment lags behind too. Large corporations invested 60% less in 2022 than their American counterparts, according to the McKinsey Global Institute. Per capita income is on average 27% lower than in the United States, and productivity growth is slower than other major economies, while energy prices are much higher. The EU has taken some steps to keep up. It passed a Green Deal industrial plan to speed the energy transition and proposed an industrial defense policy for the first time, but that's dwarfed by the amount of resources committed by the US and China. Let's speak now to Frederick Eriksson, who is the director of the European Centre for International Political Economy. He joins us from Berlin. Good to have you with us, Frederick. What's it going to take to prevent Europe sliding into irrelevance in terms of economic clout and becoming a much diminished global power?
There's many things that need to happen, and I think you've already pointed to many of them in the report that you just had. We need to raise economic growth in Europe, and we need to raise it a lot. We have had sort of in the core EU an economy which has been growing at less than 1% a year over the last 12 years. And we probably need to raise that rate at least until 3% if we're going to catch up on other economies in the world that have been moving ahead faster than Europe. So a very, very strong focus on raising the growth levels and getting that sort of underlying dynamism in the European economy to work again. That's what's required.
But with national governments often putting their own interests ahead of that of the bloc, with 27 economies that aren't yet fully integrated, to what extent is Europe's lack of competitiveness a nut that simply can't be cracked?
Well, it can be cracked, but I don't think we should expect a big top-down solution coming from Brussels that are going to instruct Rome or Berlin or Paris what they're going to do in order to revive economic growth. A lot of this needs to happen locally, nationally. We're talking about reforms about freeing up the economies, about liberating capital markets so that all the savings that Europeans have, that they actually can put to corporate use. We're talking about radically increasing spending on R&D and making sure that there is European companies that are at the frontier of global technological change. I mean, these are the things that we've been missing to do over the last 25 years. And that also explains why we've been falling in these poverty or sort of richness rankings that you alluded to. Average EU country right now, we would be poorer than Mississippi if we were to be a state in the United States.
To what extent, though, have Europe's people intentionally chosen to be less competitive by, for instance, opting to work fewer hours than their American counterparts? It's all part of the European way of life, isn't it?
Well, I mean, that's what many people think it is. And I mean, if you want to sort of explain why, sort of say, the average American was having a higher income than a European until, say, 1995, the main explanation was that the average American was working longer hours than the Europeans were. Since then, there hasn't been much change in sort of how much Europeans work and how much Americans work. What has changed is that for every hour that goes into the economy, the US worker has become so much productive than the EU worker has been. The EU worker tended to be more productive than the average American worker until late 1990s. But for the past 20, 25 years, there's been sort of a gap going in the opposite direction where the US economy is more productive. And that doesn't mean that it's throwing more working hours and more capital into the economy. It means that they are using all these inputs in a much smarter way.
What about the argument that that competitiveness should be left to the open market and that it's not collective action by government that it's needed, it's more private investment?
I think that's obviously the case. I mean, it's going to be an extraordinarily difficult task if a government or the European Union in Brussels were to set itself a task to sort of in a command economy structure try to deliver that growth on its own volition. It is the market, it is companies that are going to be the major drivers of this change. But the markets and the companies also need to be liberated. Right now, we have had a dozen of years with rapid increase in regulations in Europe, and regulations that are in most cases going harder, deeper, and faster than any other comparable economy in the world. So that is a change which needs to come through political decisions. It's the same with problems we have with capital markets, with R&D, with the size of investments. Governments can do a lot of things just by stepping out of the way and basically allowing the animal spirits of the market to do the job for them.
After last week's election, to what extent will the makeup of the new European Parliament make it easier or harder to make Europe more competitive? A lot of people voted, for instance, against immigration. They went for more right-wing parties who've pledged to reduce immigration. But that's what Europe needs, doesn't it? With an aging population, immigration, it's going to be its savior when it comes to competitiveness?
I don't think immigration itself is going to be a savior, a panacea, but I think you're absolutely right that Europe needs more immigration. It also needs more immigration across the board. And perhaps what we're missing the most right now is high-skilled immigration. We have a global competition for talents, and Europe right now is not winning that competition. We educate a lot of engineers, computer engineers, AI engineers in Europe, but we have a net outflow of them, people educating themselves in Europe and then moving to other parts of the world because there is much more action in other parts of the world in these technologies. So it's perfectly reasonable why they want to go. But we need to reverse that trend, and we need to sort of make it easier for companies in Europe to hire, to get access to the human capital they need to grow. What I would say, though, is that I don't think the European election that we had now is changing sort of much when it comes to the overall direction of the European economy. We did have advancements for extreme right parties, but we also could see that the center-oriented type of parties basically kept the control, and they have the ability to form a majority in the parliament right now. What we should worry about is much more developments that are happening in individual member states. Take, for instance, France, where President Macron had to call a snap election just because of the enormous surge for the extreme right party in France during the election. And if that party was to take over the government in France, I mean, that's going to have tremendous consequences for the ability to turn its economy around, because that is a party which favors protectionism, nationalism. It favors a very, very strong government that takes control over many companies. And it's going to be sort of a Europe that becomes even more inward-looking and think that it can hide itself into success.
It's always good to talk to you, sir, on Counting the Cost. Many thanks indeed for being with us.
Thank you.
Now, financial institutions in Sudan's capital Khartoum have been destroyed by the fighting between the army and paramilitary rapid support forces. That's made it difficult, of course, for people still trapped in the city to get access to money, while the prices of basic commodities have skyrocketed. Hibba Morgan reports from Omdurman.
Sumaya Abdullah has come to this shop in Omdurman in Sudan's capital Khartoum, not only to buy goods, but to get cash. She says it's the only way she can get money from her bank account after fighting between the Sudanese army and the paramilitary rapid support forces led to the destruction of many banks in Khartoum.
I use the online banking app because there's no way to pay for bread or groceries unless I transfer to the shop owner here and get cash from him. Not everyone has the app. The milkman doesn't have the app. The grocery store doesn't have the app. So I come here, buy things, and transfer extra to get cash.
The conflict, which started more than a year ago, has seen the destruction and looting of many banks in the capital. Those who can have relied on online banking apps to access their much-needed savings as the prices of goods continue to rise.
With the war, we rely on the transfers we get from outside, and things are hard, so you can't always find cash. So we rely on the online banking app, specifically the Bank of Khartoum app. It's easier, more widely used. We can use it in shops, pharmacies, and exchange cash through transfers via the app.
But the now common way of getting cash is not always available. Online banking apps rely on the internet, but many parts of the capital and several states are experiencing an internet blackout. And this is what most banks now here look like, which has made it hard for millions across the country to get cash to buy their daily needs. The destruction of financial institutions has led to the loss of billions of Sudanese pounds, further limiting people's abilities to access cash, even in safe areas. The State Bank of Khartoum has recently opened a branch in Omdurman, and that's been helpful for many, but it doesn't provide full services.
Since the start of the war, I've stayed in Omdurman. I get transfers from my relatives outside, so having access to my account is crucial. I can't get cash from the bank yet, but I can use other services. But this gives me hope that things may improve.
Banks here say they're working to provide services to their clients, but for now, the easiest way to do that is through the app.
In safe states, we provide full services, but we're striving to provide those services in the capital as well, so that people don't risk their lives to go to other states to access their funds.
While banks try to find ways to provide services to their clients, Sumaya says she will continue to rely on shops to be able to access her account and buy what she and her family need. Hiba Morgan, Al Jazeera, Omdurman.
Now, let's turn to India, where Prime Minister Narendra Modi has been sworn in for a third term. His party, the BJP, campaigned on India's explosive economic gains. The nation now has the world's fifth largest economy, but a high unemployment rate and income inequality are among the biggest challenges facing Modi. Introducing economic reforms to fix them and grow the economy even further could now be a challenge for the Prime Minister, who lost his majority in Parliament. Well, Modi's government has pledged to make India the world's third largest economy in a few years' time. Investors say that that could happen if the country plays its cards right. Its economy grew by more than 8% in the last fiscal year, and it's on track for more growth. Let's take a look at the numbers. Currently, the United States has the highest GDP at around $27 trillion. That's followed by China, Germany, and Japan. India is ahead of the UK with a GDP of more than $3.5 trillion. Now, a major driver of that growth is infrastructure. And now India is also looking towards manufacturing, which accounts for nearly 17% of GDP, and it's aiming to replace China as a global production hub. Now, despite the explosive growth, there are significant challenges. More than 40% of college graduates under the age of 25 are unemployed. There's plenty of jobs in agriculture and construction, but vacancies are limited in other sectors. Income inequality has also widened under Modi's watch. A report by the World Inequality Lab shows the richest 1% owns around 40% of India's wealth. So let's get stuck into this with Jayoti Ghosh, who's a professor of economics at the University of Massachusetts Amherst in the United States. She joins us today from Bangkok. Good to have you with us, Professor. So will Prime Minister Modi be able to push through tough, business-friendly reforms as the head of a coalition government?
Well, I think the real question is which business-friendly reform has he already not pushed through? The only ones he failed at were, in fact, when he tried to do the farm laws, which were, in fact, seen by farmers to be extremely against both Indian agriculture and the farmers themselves. And I don't think he's going to try that again. I don't think the coalition will have any major problem with what you would call business-friendly, but I would argue that continuing along the same road that he's taken for the last 10 years will not be good for the Indian economy, and therefore finally will not be good for Indian business.
All right,
because it doesn't address the real problems.
All right, so what should the new administration's priorities be?
They should really be employment generation and controlling inflation. The big issues for people today are the lack of adequate jobs and the very high rises in cost of living, which means the real wages that were stagnant over about a decade are now falling, and food poverty is increasing. So you really have to address those. And that means focusing on the things that will create jobs, focusing on more social services, on health, education, sanitation, focusing on small, micro and medium enterprises and looking at their needs, because that's where employment generation is dominantly going to be happening.
What about his previous focus on manufacturing? Are you saying that was probably a mistake, that he took his eye off the ball there?
Well, I don't think it was a mistake. It was just a failed attempt. There hasn't been any increase in the share of manufacturing in the Indian economy. There hasn't been a significant increase in manufacturing employment. In fact, if anything, there's a slight decline. And so really the problem is not that the intention is good, but the delivery was not there.
With many of the country's workforce still unskilled and working in agriculture, what does the government need to do in terms of upskilling and education right now? Should that be a priority?
Absolutely. We are one of the few countries that didn't actually make an effort to change after the pandemic. We should have recognized that the pandemic meant a huge loss in education at all levels, especially for first-generation learners. Many of them forgot everything they had learned in school. We try to do online learning in a country where, even mobile penetration is relatively limited. And perhaps in poor families, it's only one mobile per family, which means children really can't access it for schoolwork all the time. And so we had a major loss. And still, we haven't really put in the required investment to make sure that we can recover that. So I think education should be a major priority, but public education, not privatized education that people are paying through the teeth for and then not getting jobs.
And what does the government need to do to bring down the country's high unemployment rate, particularly among the young?
I've identified two major areas where employment has to go up. One is in public services. Currently, we massively underprovide public services. Our total public health spending is only 1% of GDP, and we have very few health workers, public health workers per population. So we need to triple that. And we need to dramatically increase our spending on education as well. As I've already mentioned, these are hugely employment creating. And they have positive multiplier effects. They will lead to secondary employment benefits as well. Also, the big potential employer in our country are the micro, small, and medium enterprises. We have to make them viable. At the moment, it's a miracle that they can survive at all because they face all kinds of constraints, not just infrastructure, which the government is looking at, but credit access, marketing access, raw materials, knowledge, technology. And so we need a package that will actually deliver to micro, small, and medium enterprises the same kind of playing field that large corporations get by definition.
But Professor, I hear you say we need to. The question is how?
Well, that's quite simple. There have been so many proposals put forward in the previous government, and I'm sure again. And so in effect, what we need to do is well known. It's really a question of political will, of shifting the focus away from thinking that providing huge incentives to a few favorite large corporations is going to solve either the employment problem or the diversification problem. We need to focus specifically on these enterprises, and we need to dramatically increase public services. That's fairly straightforward. It's not, it's a no-brainer about how to increase public employment in health, for example. You have to spend more. And you have to recognize that you need to spend more and provide the money for that, instead of just giving large tax breaks to big corporations, which is what the previous Modi regime did.
Really good to talk to you on Counting the Cost, Professor. Many thanks indeed for being with us.
Thank you.
Religious tourism contributes around $12 billion to Saudi Arabia's economy each year and 20% of its non-oil GDP. Revenue from the sector is expected to grow further, with an estimated 1.6 million pilgrims converging on Islam's holiest sites this year. The Hajj pilgrimage is also a boon for travel agencies, airlines, and the hospitality industry in the kingdom and the wider Gulf region. Well, Saudi authorities have recently spent billions of dollars on developing the kingdom's holy sites in Mecca and Medina. The kingdom aims to increase Hajj and Umrah capacity to 30 million pilgrims each year as part of its 2030 vision to diversify the economy. Performing Hajj can cost upwards of $5,000 per person, and it's one of the 5 pillars of Islam. Every Muslim who's physically able and can afford it is obliged to perform it at least once in their life. For more on this, let's talk to Turab Salim, who's a partner and head of hospitality, tourism and leisure advisory for the Middle East and North Africa at Knight Frank, a global real estate consultancy firm. He joins us now from Riyadh. Good to have you with us, sir. Just how important then to the Saudi economy is religious tourism?
Thank you for having me. Religious tourism is one of the backbone of the overall tourism. Overall tourism in kingdom is thriving, so does the religious tourism too. I mean, the next year target is around 30 million religious tourists, which will keep growing as per Vision 2030. So it is playing a significant role. Earlier, it used to be seasonal business. Now, since after pandemic, the business has revived now. It's a year-round. Both the cities are touching around 70-75% occupancies. So it's no more a seasonal business. It's a year-round business. And projections are it will keep thriving in the coming years as the rest of the tourism is also in a very positive growth trajectory.
But can the holy sites themselves cope with an ever-expanding number of pilgrims? Is there a risk of overdeveloping them?
A good question. I think there's a huge potential in religious tourism, but it very much boils down to how much your infrastructure can take. So government is spending a lot on enhancing the infrastructure. So the more you expand and enhance your infrastructure, the more capacity can be absorbed. So already there are $72 billion is in a pipeline just for these two cities to develop around 231,000 keys. And this is apart from the infrastructure development fund, which is separate. So only the room inventory will enhance by another 221,000 in the coming few years.
So with the continued expansion of the holy sites and the country's ability to deal with ever-growing numbers of pilgrims, does that mean that costs for pilgrims themselves will come down, or will it continue to get more and more expensive?
I think with the time, there are a lot of initiatives are taken by the government. There are new airlines coming in. There is an airline is the biggest feeder of tourism, religious tourism to the country. So there is a limitation with that capacity, which is now with the Air Riyadh coming in the picture, 2 more new airlines coming into the picture within KSA. It will help to ease that down. Plus, when you have enough facility, enough room inventory in the pipeline, then for sure it will help diluting because right now the capacity demand is so high and the capacity is limited. It means it will help, or it will push the rates up, which will make the overall expenses that will be beyond normal limit. But when you have enough room capacity, when you have enough airline capacity, it will help to bring the price to what people can afford. Affordability is important, and it is a part of the overall scheme.
Really good to talk to you, sir, on Counting the Cost. Many thanks indeed for being with us.
Thank you. Thank you for having me.
And that's our show for this week. If you'd like to comment on anything that you've seen, I'm at @afinnegan on X. Try to remember to use the hashtag AJCTC, or you could drop us a line. countingthecost@aljazeera.net is our email address. As always, there's plenty more for you online at aljazeera.com/CTC. That takes you straight to our page, and there you'll find individual reports, links, and even entire episodes for you to catch up on. But that is it for this edition of Counting the Cost. I'm Adrian Finnegan from the team here in Doha. Thanks for being with us. The news on Al Jazeera is next.